When systems feel stable, people trust what they cannot see. As long as the system feels predictable, those promises feel sufficient. When that sense of stability weakens, behavior starts to shift quietly. When people lose faith in the system, they stop thinking about intangible concepts and start focusing on things that feel real. This shift is driven by psychology rather than calculation. Modern financial systems depend on trust. Trust that currencies will retain value. Trust that institutions will operate as expected. Trust that rules will remain consistent. As long as that trust holds, numbers on a screen feel real enough. When trust comes into doubt, people begin to reassess what they rely on. They think more carefully about who owns what. They pay attention to what depends on external guarantees. They look for value that exists independently of complex arrangements. At this point, hard assets like gold or silver begin to attract attention. Gold does not produce income. It does not generate cash flow. It does not adapt or grow. Its appeal comes from a different place. It feels detached from the system. Its value does not depend on corporate earnings. It does not hinge on institutional performance. It does not require constant confidence in layered structures. In periods of uncertainty, simplicity becomes appealing. This explains why interest in hard assets often rises during times of systemic stress. People are not necessarily expecting exceptional returns. They are reducing the number of assumptions they need to make. This behavior is not exclusive to gold. It appears in the desire to hold cash, in rising interest in property, in a broader preference for tangible ownership. The form changes, but the instinct stays the same. The focus shifts from growth to control. But there is a common mistake. Shared behavior explains why attention shifts. It does not guarantee good results. When many people move for the same reason, too many end up in the same place. Crowded positions tend to lose their sense of safety over time. The more important lesson lies elsewhere. It lies in understanding why these shifts happen at all. During periods of confidence, people prioritize efficiency. During periods of doubt, they prioritize security. Economies move back and forth between these states. Recognizing this cycle matters more than anticipating short-term price movements. Systems rarely fail without warning. They communicate stress through behavior long before breakdowns occur. Increased interest in hard assets often reflects that tension. It is not a verdict. It is not a forecast. It is a signal. A signal about how people see the structures around them. Those perceptions shape decisions well before charts or headlines confirm anything. Prices will fluctuate. Currencies will adjust. Markets will adapt. The behavior itself remains familiar.